Welcome to the Daily Update, where I'll go over the action in the market for Monday, June 26th, and then we'll see how things look for Tuesday, June 27th. We had another down day as far as the S&P is concerned, and we closed pretty much near the low for the day. That's doing some more technical damage to the S&P 500, but we're still above some pretty critical support. The idea is to see what's going to happen if we continue to fall. Will we be able to bounce up off of that support? Or are we going to break through that support? We're seeing things shift gradually a little bit more negative, but there's still some positive signs in the background that I'll go through. Now, before I get started, please know that there's a PDF of all the slides and charts that are available in the description below the video. Also, I have a private Facebook group that you're welcome to join. I do have a new poll that I posted over the weekend. Feel free to check that out. That's on the YouTube community tab. Also, with YouTube comments, I try to really be diligent about getting rid of garbage comments. If it includes a name or a number like I made $45,000 this last week from Mary Smith, who's a genius, I'm going to wipe that right off. Or if you post something that I really can't answer, you're just making a statement, I'll just kind of ignore that, but I'll usually leave that up. Also, please note that I also post on Rumble. Here is the channel if you need to find me that way for whatever reason. Let's go back and talk about what happened. At the open, we had a little higher open. The futures were slightly positive. It looked like maybe we were going to get some kind of a bounce. Well, that didn't last very long. We made it up to R1 at 43.63. Then once we hit that level, we fell back down below the daily pivot at 43.52. Then the unchanged level, which often acts as support, not on Monday, we ended up falling down below that. As the day went on, prices remained below the unchanged level. It did become a resistance level later on. We ended up falling down below S1 at 43.38, and then we did attempt a rebound, but we then closed at the low just above S2 at 43.27. So we were down 0.45%. One thing that is encouraging, volume is now back to below average. The technicals are positive, but they're shifting more negative now, especially in the short term. We're turning more negative in the intermediate term. We're still okay for right now in the longer term. Inflation and interest rates are what the market is focused on. However, over the weekend, there was a geopolitical event that happened in Russia. That has kind of captured the headline news. We're still waiting to see what some of the facts are behind that whole situation. If that had escalated even more, or if something reignites concerning that situation, it may have an impact on the overall market. What are some comments that we can make? Mega caps were weak. That's why the indexes were down. Since all of the indexes are heavily weighted, the big guys ended up having some weakness. That took the indexes down with it. But the broader market held up well. And as I go through some of the charts, we saw a few upticks with a few of our indicators. On an intermediate term basis, our oscillators are still rolling over after giving us extreme positive readings. On a short-term basis, we still have the Stochh RSI that is oversold. The dollar was down and interest rates were down. Now, both of these should have given some support to stocks, but they really didn't do that. We still have all of our yield curves that remain inverted that we follow. Sentiment is still positive. It had been at 74, then it ticked down to 72. Our trend is positive. The green line is still on top, but it is declining, and we're just about ready to cross below the moving average, but we're still a little bit above it for right now. However, both are still above 20. Our bias is negative because we've had 4 down days now, and our momentum is also negative. We did not have any economic reports that came out on Monday, but as the week goes on, we will be getting more reports. Probably on Friday will be the most important report. We get another inflation gauge at that point with PCE prices. Looking at some IsabelNet blog charts, this is a historically weak period of time right now when we get into the third week of June. The yellow area is this overall time where we tend to see some weakness historically before we see some strength going into the end of the month. And this is based on going from 1950 up to 2022. Then we also look at the largest inflow to financials in 10 weeks. Last week, if you recall, I showed a chart that said that there's heavy insider buying in the financial sector. We're starting to see some money coming back in. We're not really seeing a real follow through with price yet, but there is a lot of money that is heading back into the financial sector. Also, just the latest reading on GDP. We'll get the third estimate later this week. Goldman Sachs thinks that we will not head into a recession, at least according to this measure. They see us having positive GDP across the board, where for the third and fourth quarter of 2023, the consensus is that we will have negative GDP. Looking at the 10-year analyzed returns, they're strong for tech stocks. We're up about 20% as of the time this chart was created. Then looking at the Deutsche Bank recession probability over the next 12 months, they're at about 100%. Now, they're in the camp, of course, saying that we will head into a recession. There's other information that we look at that suggests we're not necessarily heading into a recession, and that is part of the debate going back and forth. Then we look at the debt allocation. This means bonds. It is ticking down a little bit. Bonds haven't been performing as well as a lot of people would really like. And then we were seeing a nice run up there in the stock market, and they may be doing a little bit of shifting of their funds. Then looking at 88 global rate hikes year to date against 17 cuts, all of them in emerging markets. The red line here is taking all of the rate hikes together. This is producing some global concerns of a slowdown economically. It's one thing to have one country or the US or Europe be slower, but when it's happening on a global basis at the same time, that's a little bit more of a concern. We also have China that's starting to cut rates as well. Edward Yardeni had an interesting chart looking forward at the earnings per share and then the actual operating earnings where they're starting to turn back up slightly. Real Investment Advice had a few interesting charts. This came out last week. This is the leading economic index where it's now getting down into this recession area. And I pointed that out at the time the report came out. Also, another chart of the LEI showing that we're coming down to this dangerous level when we compare it to the economic output composite index. And this is what a lot of folks are using to say, yeah, we're going to go into a recession. Look at the other times we had these low readings and it pretty much always led to a recession. Then looking at sentiment with the stock market, they have two different sentiment gauges here. The CB, which is the black line, that's consumer confidence, which will be coming out. And then the red line is consumer sentiment, which will be coming out with their final reading on Friday, where consumer sentiment is ticking up a little bit, but it's still very low. Consumer confidence seems to be kind of high. And then the blue line here is the S&P 500. Then we're looking here at a global slowdown. This is the composite of the Purchasing Managers Index. I covered this over the weekend, showing that we're seeing more of a global slowdown no matter what country you look at. Getting into our charts and analysis, here's the intraday chart. It looked like we were going to be a little bit more positive. We had a flat to higher open. We were able to get up to R1. That was the high for the day. Then we fell back down below the daily pivot, down below the unchanged level. We tried to come back up, but now the unchanged level acted as resistance. We fell down to S1, danced along there for a while, tried to make a bit of a rebound, but then right late in the day, we saw some selling coming into the market. We closed above S2, but we did close at the highs for the day. I've also marked on here the August 2022 high. It's at 43.25, where we closed at 43.28. Looking at the SPY 10-minute intraday chart where we were drifting off a little back on Friday. Then when trading resumed on Sunday, we were seeing a bit of an improvement and that helped give us a positive open, but that didn't last very long. We ended up going negative and then closing near the low. We're drifting a little bit higher in the initial overnight session. Large cap growth versus large cap value. We're seeing where growth is now underperforming value. And here's the closing basis where value was up, growth was down. Growth was up for the mid caps, but less. And growth was also up for the small caps, but again, about half as much. Here's our chart showing some weakness here. This is a little bit concerning. Even when we saw some attempts at rebounds during Monday's session, the growth to value ratio was continuing to really go down. This could be folks locking in some profits, especially in the mega caps, to see this overall ratio decline, but this is something to keep an eye on. Our sentiment gauges were ticking up just a little bit with the Ulcer Index. Here's another look from Simple Advisor, where they have us more in the extreme category. We're back more in the yellow area if you compare both of them. Another sentiment indicator also is showing that we're extreme positive. Then looking at the VIX, we ticked up slightly on the line chart as well as the bar chart, but the reading is still quite low. The VIX of the VIX is also showing a pickup in volatility. Then I wanted to show this. I usually only show this in the deep dive video, but I wanted to bring this up. This is a chart of the VIX. You can't see it because it's invisible. Then on top of that is a 50-period exponential moving average. And this gives us the range over a period of time of where the VIX trades. There are static numbers that we can use. Usually it's 12.5 to the downside, 20 on the upside. But when we look at this moving average, this gives us a more dynamic look. The VIX can change in its ranges during different climates. We're starting to come down now, and we've even dropped below 20 with our longer term range. Not anything all that spectacular, just something to be aware of. Then looking at the equity put call ratio, it ticked up slightly with the down day. We're not really working off of a signal here. We had some other signals in the past that really didn't lead to much, but this isn't starting to spike up as we're going back down, which is normally what we see. Also looking longer term, we're seeing the rollover continue with our 253 period simple moving average of the equity put call ratio. This could be turning more positive. The VIX to move ratio ticked up in Monday's session, but we're still below a declining moving average, showing that fear is still relatively low. Then we look at the move index where it ticked up slightly. Also the VIX turned up slightly, and the correlation between the two is getting a little bit stronger. Looking at this fear gauge, we ticked up just a little bit, but we've still been going down overall. This other fear gauge also ticked up, but we have been going down. The risk on, risk off ratio that we look at also continues to fall as we're seeing some more profit taking. Our advanced decline line, this is where we're seeing some positive signs. We turned up a little bit based on price, but we were flat based on volume. The new highs continue to hang in there. Even with a down day, we saw the new highs actually be higher than the red bar, which are new lows. It's turning our 5-period back up slightly. We're turning up just barely with our 10-period differential. This is another positive side. And the blue line, which had dropped below zero, crossed back above zero. So now both the red line and the blue line are more in positive territory. This is negative. Accumulation distribution has now dropped below the moving average. Then looking at our cumulative advanced decline line for the NYSE, we actually ticked up a little bit on a down day. And then when we look at the other advanced decline line, it also ticked up slightly. The other advanced decline line study that we look at is trying to turn and come back above this trend line. Common stock also saw a little bit of a tick up based on price and barely a tick up based on volume. Then our broader range, the NYSE, showed a little bit of improvement, as did the S&P, the mid caps, and the small caps. So the big boys took the indexes down, but internally we were seeing a little bit more strength on Monday. Looking at our trend, this is where the ADX is just about ready to cross below the moving average. That would denote a weakening trend, even though it's still above 20. The green line's on top, so we default to positive, but it is declining, and the red line is starting to increase. Our shorter term look at the ADX also has us dropping below the moving average with the green line declining. They're still pretty extreme positive in their reading, but the red line is also starting to advance. We saw a tick down in volume, and that could be considered positive for a down day. Short term, we're coming down to the August 2022 highs. On this chart, it looks like we hit it. We haven't quite hit it yet. And I also extended this trend line because it may be producing some overhead resistance. Then on the bottom, you can see where volume did drop below average. We saw a bit of a tick up with our 20, 50, and 200 period moving average study. But we are dropping below the double and triple exponential 20 period moving average, and they are starting to roll over. So that's more short-term negative. Then we look at our normal 20 period simple moving average study. We're still above both of these. This may provide some support if we end up dropping down to that level. We're also dropping below the 10 period moving average in the rainbow, and also seeing if we'll find support at the 20 period. The Stochc RSI still remains extreme negative. Looking at our stochastic study, we're no longer extreme with the short term and heading down pretty fast. Intermediate term, we're also dropping, and we're just coming out of being extreme positive with our long-term stochastic. The force index continues to be below zero. Intermediate term, the balance of power is showing some weakness, but is still above the dashed line. Then looking at the 50-period double and triple exponential moving averages, we're right down to the 50-period double exponential moving average. We were hoping that maybe the triple would provide support. No, that wasn't happening. Now we'll see if the double will provide support. Then our moving average tree. I haven't shown this in a while, but since we're getting close to the 20-period moving average, I wanted to bring that back up. The go-no-go system remains more neutral with the lighter colored blue bars. This is a new chart that I just added over the weekend. This takes the highest high and the lowest low over the last 14 periods. When we're hugging the blue line and going up, that means we're quite positive. When we're going down and hugging the red line, that means we're more negative. Right now, after being quite positive, we're starting to come back down, and I also put a midpoint right in the middle. We're just barely above that midpoint currently. TTM squeeze, after being extreme positive, is starting to drop, and here's a longer term look at that same chart to compare other times when we had an extreme positive reading. We're coming back down. We're still above the midpoint with our standard deviations chart, but we're no longer extreme. Looking at our Arun, where we're seeing a decrease in buyers as well as a decrease in sellers, so our oscillator ended up being unchanged on the day. The PPO study is still positive in the long term, intermediate term. We're still above zero in the short term, but we are declining. The S&P McClellan oscillator has dropped below zero, but actually turned back up, even though the S&P was down. Then the NYSE McClellan oscillator also turned up, but is still below zero. So our summation index based on price continues to fall, and it's also falling based on volume. Then our NYSE summation index based on price turned down slightly, as well as with volume. The Swenlin trading oscillator based on price and volume continue to decline, and they're both below zero. The PMO starting to roll over, but hasn't quite crossed the moving average yet. We're starting to cross based on price, and we've already crossed based on volume. Then looking at our PMO study, again, a down day, but the PMOs that were rising ticked up. We're still seeing a decrease with the buy signals, and we were flat with the PMOs that are above zero. The Elder Impulse system for the S&P is now switched to negative with a red bar. The parabolic SAR remains negative with the dots on top. The slope oscillator has already crossed over negative, and the MACD has also given us a cross negative. So when we look at all of our oscillators, the slope and the MACD are negative. The TSI is also crossing over negative. The PMO hasn't quite crossed yet. The PPO has. Longer term, we're seeing the TRIX and the KST beginning to roll over from an extreme positive reading, but they have not crossed over at least yet. Then looking at the BPI, this is holding up. To have a down day like we saw, it did decline, but we're still above 50. The NYSE bullish percent index also did decline and remains above 50. The Chaikin money flow declined but is still positive. The Chaikin oscillator, though, has dropped below the zero line and is looking more negative. The money flow index continues to fall but is still above 50. Ultimate oscillator has now dropped below 50. That's negative. The vortex, the green line, still on top, but it is declining as the red line is advancing. On balance volume, still positive since we're above this moving average, but we are declining. The RSI 14 is still declining, but it's above 50. With the 9-period RSI, we're just barely above 50 right now. Then looking at our 200-period moving average study, we actually ticked up slightly, so that's somewhat positive, both with the 200-period and with the 50-period study. And then here's another look at that same chart based on a histogram to see if that gives you further insight. The Pring bottom fisher is still generating a buy signal. Then looking at our Fibonacci lines, if we really start to fall, we'll be watching the 4170 level or thereabouts. We're also still above this 100% retracement level. If we fall much further, we're going to break below that. We're waiting to see, will this area end up providing support? Longer term, we're also coming down to the 61.8% retracement level. If we fall, will that provide support? And then longer term, we have quite a ways to go before we get to this fib retracement level at 42.14. Then I usually don't show this very often, but this is the 20-period simple moving average of the open, high, low, and close. After going up nicely, we were far away from all of these moving averages, so I wasn't showing this chart. Now we're starting to come back down, and we're hitting the high moving average now. Will that provide support, or will we continue to fall below that? Our different charts still looking more negative with the Heikin Ashi. We're still positive with the Kagi chart. It's black, but it's pointing down. The Renko chart has not redrawn yet. However, the 3-line break is starting to turn more negative. Our other indexes, we actually saw a bit of a tick up with the equal weight index. It actually outperformed the S&P, but on a longer term basis, it continues to underperform. The equal weight to S&P 500 ratio did tick down slightly. And looking at Dow theory, we saw a little bit of strength in the transports. We saw a little bit of a bounce with the utilities. The transports are showing some improvement but continue to underperform the Dow. Then looking at discretionary versus staples with our equal weight, discretionary is in an uptrend, staples are still in an uptrend. Our ratio declined just slightly with discretionary outperforming staples. Looking at the Dow, this is also positive. We still have been able to close above the 50-period moving average. It's held for 2 days now. But the diamonds on the Dow have now switched to negative. The NASDAQ is still holding up above this pivot level. And if we continue to fall, we'll be watching this 50% retracement level. We came up to the 61.8% level and have been falling back. Are we starting to really reverse things, or will we possibly come down to this level and be able to bounce off of that? The new highs, new lows cumulative measurement that we look at continues to fall for the NASDAQ, and when you take the new highs minus the new lows, we continue to be below zero. The NASDAQ 100, after trying to test them high, has now been dropping back down. We broke just a little bit below this pivot level, but we're also still above this other pivot level. The Qs have now switched to negative for the Elder Impulse system. This is something that David Keller from Stock Charts pointed out over the weekend. He says this is a major signal. I just included it as part of my overall analysis. We were given an extreme positive reading with the BPI for the NASDAQ 100, and now we're starting to come back down. He thinks that's a big deal, and it might be. I'm just treating it as, okay, we were extreme positive, we're falling back. Now we're waiting to see, are we going to shift more negative, or are we just going to wear off some of this overbought condition and then turn and go back higher? Then looking at the NASDAQ 100, we still have the 61.8% retracement level well below where we're at right now. Typically what has been happening is the Qs have been outperforming the Dow. Well, that didn't happen in Monday's session. The Dow outperformed the Qs. Small caps, we still are holding up above this support level, and we were able to almost get back up to the 200-period moving average. Also, with our Russell 2000 small cap index, we turned up slightly with the RSI, but the MACD still remains negative. The Elder Impulse system for the small caps remains negative. The small caps ticked up just slightly, but are still really underperforming the large caps. But when we look internally and we look at growth versus value for the small caps, we're still in an overall uptrend, even though it ticked down slightly. The mid caps also had a pretty good day, up 0.78%, but still remain below this pivot level. However, we did see a recent golden cross. The Elder Impulse system for the mid caps remains negative with a red bar. But when we look internally, mid cap growth has been outperforming mid cap value, but we did tick down in Monday's session. Then the home builders, they just continue to go up. Even with the S&P going down, the ratio is really starting to go up, and the relationship between the two is starting to get stronger as the home builders catch up to the positive things we had been seeing with the S&P 500. Right now, this should be taken as positive. When the home builders outperform the S&P, that might give some support to the S&P 500. And when we look at the S&P and compare it to 3 to 7 year Treasury bonds, even though we're declining, the market is still anticipating a soft landing. And home construction, compared to bonds, we're still seeing this ratio continue to go up. Keeping an eye on the financials, they were down almost 0.25% and remain in a downtrend. We're keeping an eye on this longer term level here going back to 2007. So far it is held as support, but we're still a ways away from that. If we really start to fall, we'll be keeping a closer eye on this chart. The financials ticked up just slightly but continue to underperform the S&P. The regional banking ETF ticked up just a little bit but continues to underperform the financial sector. Keeping an eye on bonds, we were down slightly based on yield. We were up slightly based on price. When we look at the value to growth ratio and compare it with the 10-year Treasury yield, they're having a slight tendency to go in opposite directions right now, but the relationship longer term is still pretty strong. Then this is a concern, where if we were going down with this ratio, the market would feel more comfortable about their stance on interest rates. We were seeing that, enough to give a death cross with this ratio, but now we're starting to shift back. If we stay in this kind of a posture, we will end up seeing a golden cross with this ratio. And we're also still above the 2007 level hit with the 3-month yield, wondering, is that giving us some kind of a warning sign? Longer term, we have the special K above the red line. That's positive. But when we look at the weekly chart, we're dropping below the red line. That's negative. And then we're also seeing a little bit of hope here. The 150 turned up and crossed above the midpoint, where we also saw a bit of a turn up with the 200 period moving average study. Then this is one of the Isabel net charts. This is longer term. I try to cover all these things in the charts where it's giving us some upside potential. It's also giving us some potential support levels if we start to fall. The one thing to make note of is it was an inside week, meaning that the high and the low did not exceed the previous week overall. That just shows a more indecisive market. An update of our possible positive scenarios. We're below zero based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. The Qs also showing some weakness compared to the S&P, but still in an overall uptrend. Discretionary turned down slightly, and large cap growth turned down when compared to large cap value. Seeing a little bit of weakness in the large caps, a little bit of a turn down with the mid caps, and we're dropping below the moving average again with the small cap growth to value ratio. When we look at the stocks in the S&P 500 above their 50-period moving average, we're still above 50, so that's a little bit positive. With the mid caps, we're also just a little bit above 50, and the small caps were also just a little bit above 50. So we're still maintaining a little bit of a positive stance that way. Then the stocks that are above their 200-day moving average inside the S&P, it has been dropping, but it did tick up a little bit in Monday's session to above 50. The S&P to utilities ratio ticked down just slightly, but still is going up overall. This can often give good support to the S&P. When we look at the broad range of the 5-period moving average of the highs minus the lows, we're now dropping below zero. The 10-day average of the S&P highs minus the lows still remain at a very high level. We're not dropping back yet. This could be signaling an overbought condition. At the same time, if we stay up in this area, it could also suggest good momentum. Then looking at the 50-period exponential moving average of the new highs minus the new lows, we're continuing to go up. When we look at our indicator, it is dropping, but it's still above zero. The growth to value ratio for the S&P was pretty much unchanged. It's been chopping sideways, but is still in an overall uptrend. Looking at the staples to S&P 500 ratio, we tick back up with the staples, but we are declining overall. So what's our outlook for Tuesday? We're positive, but turning negative. That's the same as what I had to put after Friday's session. We're just waiting to see. We're not full-blown negative, but we're wearing off a lot of this positive condition. We have durable goods coming out, the FHFA Housing Price Index, the S&P Case-Shiller Home Price Index, consumer confidence will be coming out, as well as new home sales. Then the geopolitical events. I have Russia in gold right now. We don't know if that situation is over. We don't really know if we know the facts about what's going on with the potential coup. And then the leader of that coup, who's supposed to be a really good friend of Putin's, being whisked off to the country where I currently reside. Kind of a scary thing. Every time I hear a loud noise, I look out the window. But the market is really fixated on inflation and interest rates, which are producing global growth concerns. Then here is the economic calendar for the upcoming week. We didn't have anything on Monday. The big one will be on Friday with the PCE prices. Then here is the speaking schedule as Jerome Powell takes a tour of Portugal as well as Spain. Then looking at the Stock Traders Almanac statistics, we're neutral to negative for the Dow and S&P, where the NASDAQ is a little bit more positive, but it's still neutral to positive. We're on the 18th trading day of the month, where we might be coming to the end part of this historical weakness. The green line still is going down a little bit for the 18th day. The solid green line is also declining a bit. Now, this is just historical. There's nothing to say that we're going to turn and bounce and go up from here, but historically, this has happened in the past. Then keeping an eye on this chart, with a little bit of an update here, the NASDAQ tends to perform well into the middle part of July. So our scenarios, hard to go with the down one right now. We're not really full-blown negative, and a lot of our technicals are still positive, even though we're beginning to turn more negative. It's hard to go with the up one now when we keep having down days, and then we are in a trending environment, but our ADX is starting to weaken, and if we see any more follow-through, we're probably going to drop below that moving average, but they're still both above 20. We need to see that green line turn and go back up. So what are the warning signs that we have to worry about? Accumulation distribution has dropped below the moving average. The parabolic SAR is negative. The BPIs are diverging, but the S&P BPI continues to hold up. Now, that could fall apart at any time, but for right now, it's still hanging in there. The VIX is still showing that there's not a lot of fear. The Copic curve buy signal, which I didn't even show the chart because we've crossed below the moving average, that signal is now gone. The cumulative new highs and new lows for the NASDAQ continue to show weakness. We're still above that 3-month yield going back to 2007. Earnings season still kind of trickling in, can either be positive or negative. Some positive signs. We still have the seasonality and setups that are in the background. I usually cover those things in the weekly video. The long-term special K has switched over positive, where the weekly special K chart is switched over negative. The long-term equity put-call ratio, going back 253 periods, still looks like it's coming down, so it's turning more positive. The Pring bottom fisher still is generating a buy signal. The S&P remains above that downtrend channel upper line. If we continue to fall, I'll start showing that chart again. We're still in a basic risk-on posture. Lower price levels may provide support. We're really going to be watching that August 2022 high. We're also going to be watching those Fibonacci levels in the NASDAQ 100, and the S&P to see if any of those provide support. The S&P continues to outperform utilities, even though they were down slightly on Monday. The NASDAQ and NASDAQ 100, they're still breaking out, but they have some significant overhead resistance, and right now they're falling back. Staples, even though it turned up, continues to underperform the S&P 500 overall. The mid-caps generated a recent golden cross, and small and mid-cap growth remains positive, especially the mid-cap growth. It's looking more positive than the small-cap growth. So our conclusion, the S&P, it's positive, but it's still in the process of potentially turning negative. In the short term, we are negative there. Intermediate term, we're turning more negative, even though we have some positive things behind it. Long term, we still remain positive because we're above the 200 period simple moving average. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.